But let's get straight to our market master for the day, Sanjeev Prasad, who is from Kotak Securities. Of course, he's been speaking to CNBC-TV18 for so many years now, joins in. Sanjeev, hi, good morning. And first, at the onset, let me wish you a very happy new year. Hope you have a great one this time around. It's been very good for the market so far. But are you starting to feel that perhaps the market will now enter some sort of consolidation? Because we have big events upon us, not just the, the earnings session that's going to kick in now, but you also have the budget, then elections, etc. So how do you approach it?
Honestly, at this point in time, it looks like there's a big fight going on between fundamentals on the one hand and sentiment, which is pretty positive on the other hand. If you focus on fundamentals, the market looks really, richly valued. Many stocks and sectors are trading at, far above our fair valuations, so clearly not much of upside for many of the sectors and stocks. When you focus on sentiment and incremental news, that continues to be positive. I don't see anything negative out there which can result in a sudden correction in the market or anything like that. If you look at the macroeconomic fundamentals of India, continues to be pretty good, among the best as far as the world is concerned. Earnings growth this year, we are looking at 18%, that is FY24. Next year, for the Nifty index, we're about 11-12%. So not too bad. And if you look at the global setup, interest rates will probably start declining from March. Actually, that's what the market expectation for US federal fund rate. So all said and done, the market setup is reasonably positive. The problem is valuations are, fairly rich and discounting a lot of this positives and possibly more. So yeah, so as I said, it's a tussle between value on the one side, which is simply not there in the market, and sentiment, which is very, very positive.
Right. Hi, Sanjeev. Good morning and good to see you in as always. Sanjeev, for the past year, it belonged to the broader markets. Mid and small caps did much better than the large cap names. Do you think 2024 is the year at current valuations, you could see the large caps actually outperform and 2024 will actually belong to the large caps?
Well, we have been saying it for the last 3 months or so that, the mid cap thing is probably overdone and it looks like, there's a lot of fraud in many of the mid-cap names. One of the stocks you mentioned, I heard one of your people commenting on EHA, and if you do any sort of reverse valuation, obviously there's no way you can justify the current market cap of the company. So there are many such stocks, in the mid-cap space which are run up well beyond the fundamentals. Incremental news is positive, but the problem in the market seems to be that with every incremental positive news, the people are, adding more market cap without realizing, a lot of good news already priced in. You can't give the same news, you can't discount it 5 times, right? So that's the whole problem as far as mid caps and small caps are concerned. There's a lot of fraud in many of the mid cap and small cap names, particularly in the investment sector. And if you do with capital, investment that is capital good, defense, EMS, electricity, renewables, railways, a lot of fraud over there, to be honest with you. So my sense is, if you are more focused on fundamentals from a reward risk balance, large caps look much better. Actually, last 1 month, at least, you have seen, the large caps also starting to perform. And that is what our call was also about 1 hour, that, large caps should now probably start coming back. And thankfully, we have seen some rally in some of the large cap names. I mean, honestly, there's not much value across market cap or sectors now. We can still find some value in some of the large cap names, particularly in the banking space. But other than that, it's a general struggle to find any value in the market. If I look at fair value which our analysts have, versus the current market price. In most cases, we have maybe, just about 4-5% upside or a lot of downside. And when we're talking about 1 year forward, fair values, so the struggle is there's absolutely no value in most part of the market now.
Hi, Sanjeev. Good morning. We hear you. I think that's going to be the pain point for pure fundamental stock picker, right? Because, you've got a market at 19 times and individual stocks much, much higher. So completely hear your valuation argument. Having said that, let's talk about, as you said, sentiment is still buoyant. So we have to run with what we have here. So let's talk about perhaps what could be the big trades of 2024 as you see things right now. And around us, as we hear the chatter and the narratives, I hear sort of 2 talk points. One is banks, as you said. Do you believe that large banks will be the big trade of 24? And the second question is on this continued rush in industrials and in PSU stocks. That was a trade of 2023. Do you see that continuing into this new year?
Ultimately, you have to look at, from a fundamental standpoint, and when you see this reward risk balance being favorable and in your favor with some margin of safety obviously built in. As I was saying, the only space where I can still see some value is some of the large caps and banks, which you look at their valuations, let's say on a 12-month forward price to book basis versus where they were trading before the pandemic. In most cases, valuations are actually lower when the fundamentals have become stronger. I mean, there are some concerns about, NIMs coming down and credit costs at the bottom and all that stuff. But, those are very well-known facts, and most analysts have already built those assumptions into the models. And despite that, most of the banks are doing between 13 to 16% ROE. So presumably the books will compound at a similar number. So even if the multiples don't work from where we are, assuming no rating in the multiples, then we can still make, mid-teens returns as far as the banking space is concerned, which is not too bad. In the context of the fact that most of the sectors, I can only see downside, to be honest with you, assuming fundamentals reassert themselves. Honestly, nobody can forecast prices, so it's a futile exercise. But all I can say is if I look at the price value proposition at this point in time, there is absolutely no value in most of the parts of the market, and especially the sector you mentioned, industrials, PSUs. Obviously, that's a very, very wide space, but most of the industrial names have run up a lot. No real value over there. The problem seems to be a lot of good news is already discounted, and every incremental news the market wants to increase the market cap. It's a bit strange, right? There's a big disconnect between incremental positive news, and I'm the first to admit that news flow is going to be positive, but a lot of that is already priced in. Look at a Cochin shipyard as an example. How many new aircraft carriers is Cochin shipyard is going to deliver, which have not been already priced in? I think 2 or 3 have already been priced in. Looks like looking at the market cap of the company. Similarly, look at BHDL. So that is our problem over here. A lot of good news are priced in. If you look at the rate of stock run up, between 100 to 150% in the last 6 months or so. So where is the scope of any positive surprise left over there? So that's the challenge, when it comes to mid-cap and small-cap space, the valuation is just extremely high. A lot of positive news is already discounted in, and I hope the news flow continues. Otherwise, we have a real problem on our hands.
Actually, that's interesting you say that. I was doing a show a couple of weeks ago with Sandeep Tandon of Quant MF, and he said that the only 2 sectors that are still not in very attractive zone from a retail investor standpoint are metals and pharma. So these are perhaps, names where you can still find some valuation headroom. Would you agree with that assessment?
Metals, I don't have a very firm view. It all depends on what's going to happen to global commodity prices. And looking at the construct of the world, doesn't look like we're going to be seeing fairly strong global GDP growth. And keep in mind the fact that China ultimately is 50% of all metal volumes. Give or take, and if China is slowing down, given the challenges on the housing space over there, I'm not too sure whether you can have a real robust commodity cycle. And same is true for other big geographies, economic geographies, I should say, which are US and Eurozone. Europe continues to struggle, and US is also slowing down. So all of a sudden, then I'm not too sure what's the big trigger for a big bull run in commodity prices, given a general slowdown in global demand conditions and supply-demand dynamics. I don't think look that favorable as far as most measures are concerned. Pharma is a different proposition. You have to look at every pharma stock on a more bottom-up basis. I don't think there is thumb rule that you can use over there. As of now, also, I'm not seeing that much value in the pharma space also. Keep in mind the fact the stocks have run up, over there. Most of them are trading at, probably 25 to 30 times. Some of the domestic pharma is even higher actually on a 1 year forward basis. So not much juice left over there, but if you are trying to find places to hide, assuming there is a market correction, I don't see any trigger for that. Hopefully not, but it doesn't look like a lot of value left in pharma also at this point in time.
Sanjeev, I'm reading a note coming in from Kotak today on GAIL. I've gone ahead and downgraded it. It appears that one has running ahead of itself on optimism. A couple of these names, it appears that you're fairly cautious on them at current prices.
Tell me, what is the thesis over there? People keep on coming with all sorts of theses on the PSU names. On GAIL, when 3 months back, everybody was concerned about, or rather very excited about, high crude prices leading to much higher profitability as far as the petrochemicals and LPG business is concerned. Now that crude prices have come down, the thesis have moved, to higher gas transmission volumes. I mean, why would suddenly gas transmission volumes go up in the country? I have no idea. But that's the whole problem. The thesis just keeps on moving from one thing to another thing, and people keep on finding, value in some of the PSU names. I mean, NTPC is one more classic example. At half the market cap, a lot of excitement around on the renewable portfolio. Nothing has happened out there. Now the thesis has moved, to the creation of, coal-based portfolio. So people just, build narratives now, and market cap goes up based on narratives. Try and do any reverse valuation of many of the names. You will struggle to justify even half the market cap of many of these companies on a fundamental bottom-up basis. No, seriously, I mean, I can challenge anybody in this market who wants to have a debate on me or some of these stocks, whether you can justify the current market cap on a first principle basis. It's going to be a lot of fun, I'm telling you. Try and do things on a bottom-up basis, you will realize what is going on in the market.
Absolutely, Sanjeev. The problem is we have to find, a pure bottom-up, analyst to come and counter you, because the market is moving on sentiment and flows, and we're talking now 66,000 crores of FPI money in December, and God knows, how much later this year.
Job of most people in the market seems to be just chasing stock prices. That seems to be the job of analysts and investor agents.
So, okay, as we wind down the discussion, let me ask you about another issue that I'm sure we'll keep bringing up with you as the year rolls on. One big market event is going to be a high-profile IPO in the form of Ola Electric, right? The first pure-play EV company coming in. And every time I look at it, Sorry?
Can't comment on such things.
Okay, or not specifically on Ola Electric. My question was more broad-based, that, it reminds me of the time when a lot of the new age companies came into the market. Initially, the euphoria was built up, then the stock prices crashed, then we went through a learning curve. And now, I mean, for instance, in the case of Zomato, companies have decided the path to profitability is important. Business models are evolving. Mangalam was just telling us that, look at platform fees now a reality. So how do you see this playing out? New age, I mean, if you have a view there, and in general, some of the newer businesses that will come and list on the street this year.
Always question. I don't know what to answer, to be honest with you over here. But it all depends on what valuations they come in and so on and so forth. It's very hard, to make a generic comment on something which will, happen in the future, right? Honestly, no views on the things which I really can't comment on.
Okay, all right, fair enough. We hope to have more conversations with you, and we'll keep the valuation debate alive. That's a promise. And I wish you a very, very happy 2024 to you and your team, and of course, personally and professionally.